The Intelligent Investor, Episode 13, Chapter 13, A Comparison of 4 Listed Companies. 2 companies can exist in the same industry, but become completely different investments. One company may look exciting, popular, fast-growing, loved by the market. The other may seem boring, overlooked, less glamorous. And emotionally, most investors immediately chase the exciting one. But Benjamin Graham asks a different question. Which company actually gives investors better value? Because Chapter 13 of The Intelligent Investor is not just about comparing businesses. It's about learning how emotional perception affects investing decisions. And honestly, this chapter quietly reveals something powerful. The company everyone loves is not always the smartest investment, because popularity and value are not the same thing. And intelligent investors must learn how to separate emotional excitement from rational analysis. Part 1. Why people get emotionally attached to companies. Benjamin Graham compares real companies to show how differently investors evaluate businesses emotionally. And honestly, human beings naturally become emotionally attached to narratives. People love exciting brands, fast growth stories, innovation, hype, and market momentum. Why? Because emotionally humans associate popularity with safety and success. If everyone loves a company, people assume it must be a great investment. But Graham warns investors repeatedly, a great company does not automatically equal a great investment. Why? Because price matters, valuation matters, expectations matter. And emotionally, crowds often ignore these things during periods of excitement. For example, a company may be profitable, innovative, and successful. But if investors become emotionally euphoric, they may push the stock price far beyond rational value. At that point, future expectations become dangerously unrealistic. Again, emotion distorts markets. Part 2. The difference between business quality and investment quality. This chapter teaches one of Graham's most important distinctions. Business quality and investment quality are not always the same thing. That idea surprises many people, because emotionally people assume best company had best investment. But Graham explains something deeper. A fantastic business purchased at an irrational price may become a poor investment. Meanwhile, a less glamorous company purchased intelligently may produce stronger long-term returns. Why? Because investing depends not only on business strength, but also valuation, expectations, and emotional market behavior. Again, markets often become emotionally extreme. Popular companies receive enormous optimism. Unpopular companies receive excessive pessimism. And intelligent investors look for imbalance between perception and reality. That requires emotional independence, because buying overlooked companies feels psychologically uncomfortable, while buying popular companies feels emotionally reassuring. But Graham constantly teaches investors to think rationally, not emotionally. Part 3. Why crowds overpay for excitement. Human beings are naturally attracted to excitement, and markets reflect that constantly. People chase fast growth, innovation, trends, momentum, and emotional stories. The more exciting the narrative becomes, the more investors emotionally convince themselves this company can only keep winning. That's dangerous, because eventually expectations become unrealistic. Benjamin Graham believed markets often overprice optimism. Why? Because emotions amplify future fantasies. People stop asking what risks exist. Is this price reasonable? Can growth realistically continue forever? Instead, emotion takes over. And once emotional optimism dominates, valuation becomes ignored. History shows this repeatedly: tech bubbles, speculative manias, market crazes, different industries, same emotional pattern. Graham believed intelligent investors remain cautious during emotional euphoria, not because optimism is always wrong, but because emotional excess eventually creates vulnerability. Part 4. Why boring companies sometimes win. Now here's something emotionally interesting. Boring companies often receive less attention. Why? Because humans crave stimulation. Now here's something emotionally interesting. Boring companies often receive less attention. Why? Because humans crave stimulation. People want dramatic growth, exciting stories, massive future potential. But stable companies may quietly generate profits, survive downturns. manage debt responsibly, and compound steadily over decades. And emotionally, many investors overlook them completely. Benjamin Graham appreciated stability not because he hated growth, but because survival matters enormously in investing. Strong, disciplined businesses often outperform emotional speculation long term. Again, this philosophy sounds less exciting, but investing success is not determined by excitement. It's determined by long-term results. And honestly, many investors emotionally sabotage themselves by constantly chasing intensity instead of consistency. Part 5. Intelligent investors think differently. This chapter quietly teaches investors how to think independently. Instead of asking, "What company is everyone excited about?" Graham encourages investors to ask, "What am I actually paying for? Are expectations realistic? Is the market emotionally overreacting? Does this investment provide a margin of safety?" Again, rational thinking over emotional excitement. And honestly, this mindset feels increasingly rare today because modern investing culture constantly rewards hype, confidence, predictions, and emotional momentum. But Graham's philosophy remains disciplined. He believed intelligent investors analyze carefully, avoid emotional extremes, and focus on long-term value rather than popularity. Because popularity changes quickly, but valuation and business reality eventually matter. So what's the deeper lesson of Chapter 13? The market's favorite company is not automatically the best investment. Popularity from rationality, and emotional narratives from financial reality. Because successful investing is not about emotionally following crowds. Benjamin Graham believed intelligent investors must separate excitement from value, popularity from rationality, and emotional narratives from financial reality. Because successful investing is not about emotionally following crowds. Next chapter, we'll explore stock selection for defensive investors, how Benjamin Graham identified safer investments, why financial strength matters so much, and how intelligent investors protect themselves before chasing profits. See you in the next chapter. This is Mary's English. Let's keep learning together.